We had an enormous economic recovery, but the minds of people had been so scarred, the memories. Parents told their children. 1929 became a symbol in people's minds. I mean, if you said 1929, it was like saying 1776 or 1492. I mean, everybody knew exactly what you were talking about. In 1929, my dad, who was 26 years of age then, was employed as a security salesman by a local small bank. He sold stocks and bonds, but he mostly sold stocks. And when stocks fall 48%, and you were selling them to people a few months ago, you really don't feel like going out and facing those same people. So I think my dad probably, what I like to do is, they say now, shelter in place, which means stay at home. And there really wasn't that much in our house. We just had a small yard. It was wintertime anyway. My dad wouldn't have been puttering around the yard anyway. And it really wasn't, the television wasn't there. And he and my mother got along very well. So under those conditions, I was born about 9 months later. So I didn't notice at the time that the market was closed. But the stock market had actually recovered over 20% during that 9.5-month period or thereabouts. People did not think in the fall of 1930, they did not think they were in the Great Depression. They thought it was a recession, very much like that occurred at least a dozen times, although not always when stock markets were important. But we'd had many recessions in the United States over the time, and this did not look like it was something dramatically out of the ordinary. Actually, for about 10 days after my birth, the stock market actually managed to go up all of 1 or 2% there in those 10 days. Well, from that point, the stock market went from level of 240 to 241, which was a noticeable decline because if somebody had given me $1,000 on the day I was born and I bought stocks with it and bought the Dow average, my $1,000 would have become $170 in less than 2 years. That is something that none of us ever experienced. That may have had it with one stock. Okay, but in terms of having a broad range of America marked down 83% in 2 years and marked down 89% of the peak was in September 3rd, 1929, was extraordinary. And in that intervening period, less than 1 year after I was born, just slightly less than 1 year, my dad went to the bank where he worked and had his account. And of course, the bank had a sign on it closed. And so he had no job. He had 2 kids at that point. His father had a grocery store, but Charlie and I both worked for my grandfather. Charlie worked there in 1940. I worked there in 1941, so we didn't know each other. But my grandfather said to my father that, "Don't worry about your groceries, Howard." He says, "I'll just let your bill run." That was my grandfather. Not exactly. He cared about his family, but he wasn't going to go crazy. And one of the things as I look back on that period, and I don't think economists generally like to give it that much of a point of importance, but if we'd had the FDIC started on January 1st, 1934. It was part of the sweeping legislation that took place when Roosevelt came in. But if we'd had the FDIC, we would have had a much, much different experience, I believe, in the Great Depression. People blame it on Smoot-Hawley, and there's all kinds of things in the margin requirements in 29, and all of those things entered into creating a recession. But if you have over 4,000 banks fail, that's 4,000 local experiences where people save and save and save and put their money away, and then someday they reach for it and it's gone. And that happens, in all 48 states, and it happens to your neighbors and it happens to your relatives. It has to have an effect on the psyche. It's incredible. So one very, very, very good thing that came out of the Depression, in my view, is the FDIC. And it would have been a somewhat different world, I'm sure, if the bank failures hadn't just rolled across this country and the people that thought that they were savers found out that they had nothing when they went there and there was a sign that said closed. So the Great Depression went on and lasted a very long time, but it lasted a lot longer in the minds of people than it did actually in its effects. World War II came along, and on sort of an involuntary manner, we adopted Keynesianism. We started running fiscal deficits, of course, that were absolutely huge, and took our debt up to a percentage of GDP, which had never reached before and never reached since. So We had an enormous economic recovery, but the minds of people had been so scarred, the memories. Parents told their children, 1929 became a symbol in people's minds. I mean, if you said 1929, it was like saying 1776 or 1492. I mean, everybody knew exactly what you were talking about, and it affected stock prices in a rather remarkable way. It was January 4th of 1951 that the kid who was born on August 30th in 1930 had finished college before the stock market got back to where it was at that earlier time. So take the years from 1920 or 1929 to 1951 and bear in mind that, the country was only 140 years old when this started. That's 20 years out of this amazing 231-year lifetime of our country. That was flat out for a long time of no economic growth and no feeling by people in terms about the wealth of the country, about what American economy was worth, what all these corporations that were doing far, far, far better than they were on and on. But it took all of that time to restore in the market a price level that was equal to what it was when I was born 20 years earlier. So if you think about the fact that we're enduring a few months, and we'll endure many more months, and we don't know how it comes out. And people in the 30s didn't know how it was going to come out, but they endured, persevered, prospered, and the American miracle continued. But it's interesting in that at the start of 1954, the stock market the Dow was only at about 280. And I remember 1954 because it was the best year I ever had in the stock market. The Dow went from 280 or thereabouts at the start of the year to a little over 400 at the end of the year. And as soon as it went across 381, that famous figure from 1929, when it went to 400, everybody wondered, is this 1929 all over again? And that seems a little far-fetched because it was a different country in 1954, but that was the common question, and it actually achieved such a level of worry about whether we were about to jump off another cliff, just because the 381 of 1929 had been succeeded, that Senator Fulbright, Bill Fulbright of Arkansas, who became very famous later in terms of the Foreign Relations Committee, but he headed the Senate Banking Committee, and he called for a special investigation. He really was questioning whether we had built another house of cards again. And his committee, in March of 1955, with the Dow at 405, assembled 20 of the best minds in the United States to testify as to whether we were going crazy again. The Dow was at 400, and we'd gotten in this incredible trouble before, but that was the mindset of the country. It's incredible. We didn't really believe America was what it was. And my boss, the reason I'm familiar with this, was that I was working in New York for one of the 20 people that was called down to testify. And I remember, because Ben Graham was one of the 3 smartest people I've met in my life, and when he testified, the Dow at 404, he had one line in there right toward the start in his written testimony, and he said, the stock market is high, looks high, it is high, but it's not as high as it looks. And since that time, we felt the American tailwind at full force, and the Dow, when we made the slide, it was about 24,000. So you're looking at a market today that has produced $100 for every dollar. All you did was had to believe in America and just buy a cross-section of America. You didn't have to read the Wall Street Journal. You didn't have to look up the price of your stock. You didn't have to pay a lot of money in fees to anybody. You just had to believe that the American miracle was intact. But you'd had this testing period between 1929 and certainly 1954, as indicated by what happened when it got back up to 380. You had this testing period, and people really, they'd lost faith to some degree. They just didn't see the potential of what America could do. And we found that nothing can stop America when you get right down to it. It's been true all along. It may have been interrupted with the scariest of scenarios when you had a war with one group of states fighting another group of states. And it may have been tested again in the Great Depression, and it may be tested now to some degree. But in the end, the answer is never bet against America. And that, in my view, is as true today as it was in 1789, and even was true during the Civil War and the depths of the Depression.
Warren, you are a big advocate of index investing and of not trying to time the market. But by your having Berkshire hold such a large amount of cash and T-bills, it seems to me you don't practice what you preach. I'm thinking that a good alternative would be for you to invest most of Berkshire's excess cash in a well-diversified index fund until you find an attractive acquisition or buy back stock.
It's a perfectly decent question, and I wouldn't quarrel with the numbers. And I would say that that is an alternative, for example, that my successor may wish to employ, because on balance, I would rather own an index fund than carry treasury bills. I would say that if we'd instituted that policy in 2007 or 8, we might have been in a different position in terms of our ability to move late in 2008 or 2009. It has certain execution problems with hundreds of billions of dollars than it does if you were having a similar policy with $1 billion or $2 billion or something of the sort. But it's perfectly rational observation, and certainly looking back on 10 years of a bull market, it really jumps out at you. But I would argue that if you were working smaller numbers, it would make a lot of sense. And if they're working with large numbers, it might well make sense in the future at Berkshire to operate that way. We committed $10 billion a week ago, and there are conditions under which they're not remote. They're not likely in any given week or month or year, but there are conditions under which we could spend $100 billion very, very quickly. And if we did, if those conditions existed, the capital very well deployed and much better than in an index fund. And we're operating on the basis that we will get chances to deploy capital. They will come in clumps in all likelihood. And they will come when other people don't want to allocate capital. Charlie, what do you think about it?
Well, I plead guilty to being a little more conservative with the cash than other people, but I think that's all right. We could have put all the money into a lot of securities that would have done better than the S&P with 2020 hindsight. Remember, we had all that extra cash all that period if something had come along in the way of opportunities and so on. I don't think it's a sin to be a little strong on cash when you're as big a company as we are. I watched Harvard use the last ounce of their cash, including all their prepaid tuition from the parents, and plunge it into the market at exactly the wrong moment and make a lot of forward commitments to private equity. And they suffered like 2 or 3 years of absolute agony. We don't want to be like Harvard.
Trust timber and a whole bunch of things.
What?
Trust timber and
Yeah. We're not going to change.
We do like having a lot of money to be able to operate very fast and very big. We know we won't get those opportunities frequently. In the next 20 or 30 years, there'll be 2 or 3 times when it'll be raining gold and all you have to do is go outside. But we don't know when they will happen, and we have a lot of money to commit. And I would say that if you told me I had to either carry short-term treasury bills or have index funds and just let that money be invested in America generally, I would take the index funds. But we still have hopes. And the one thing you should very definitely understand about Berkshire is that we run the business in a way that we think is consistent with serving shareholders who have virtually all of their net worth in Berkshire. I happen to be in that position myself, but I would do it that way under any circumstances. We have a lot of people who trust us, who really have disproportionate amounts of Berkshire compared to their net worth if you were to follow standard investment procedures. And we want to make money for everybody, but we want to make very, very sure that we don't lose permanently money for anybody that buys our stock somewhere around intrinsic business value to begin with. We have an aversion to having 1 million plus shareholders, maybe as many as 2 million, and having a lot of them ever really lose money if they're willing to stay with us for a while. And we know how people behave when the world generally is upset, and they want to be with something. I think they want to be with something that they feel is like the Rock of Gibraltar, and we have a real disposition toward that group.
I read Phil Fisher's book, Conservative Investors Sleep Well. Well, I haven't slept well since he really confused me when he commented that hoarding cash was evil. He wrote that instead companies should either put the cash to good use or distribute it to shareholders. Can I get your thoughts on this?
Well, there are times when we're awash in cash, and there have been plenty of times when we didn't have enough cash. Charlie and I remember in the late 60s, when bank credit was very difficult, we were looking for money over in the Middle East. You remember that, Charlie? And
They wanted us to repay it in dinars.
the guy that wanted us to repay him in diners or dinars or whatever the hell they call them was also the guy that determined the value of those things. So we were not terribly excited about him on payday and having him decide the exchange rate on that date. But we obviously are looking every day for ways to deploy cash. And we would never have cash around just to have cash. I mean, we would never think that we should have a cash position of X percent. And frankly, I think these asset allocation things that tacticians in Wall Street put out, about 60% stocks and 30%, we think that's total nonsense. So we want to have all our money working in decent businesses, but sometimes we can't find them, or sometimes cash comes in unexpectedly, or sometimes we sell something and we have more cash around than we would like. And more cash around than we would like means that we have 10 or 15 cents around, because we want money employed, but we'll never employ it. And in recent years, we've tended to be cash heavy, but not because we wanted cash per se. In the mid-70s, we were scraping around for every dime we could find to buy things. We don't like lots of leverage, and we never will. We'll never borrow lots of money at Berkshire. It's just not our style. But you will find us quite unhappy over time if cash just keeps building up. And I think one way or another we'll find ways to use it. Charlie?
I can't add anything to that.